Hello and welcome to another edition of the Weekly Wrap-Up, where we look back over the week's events and see what investors have been focused on. Guy Foster, Head of Portfolio Strategy at Brewin Dolphin, joins me down the line to give me his insights. Mr. Foster, firstly, we can't not speak about Cyprus. What backlash did we see in the markets from this news? Have we seen pressure ease off the euro as the week has gone on due to this latest ultimatum from the ECB?
The market reaction, I think, most people would consider this market reaction to be pretty muted. And if we were to have this kind of discussion and these kind of events, say, a year or two ago, then you'd probably be seeing much more in the kind of 4 or 5% off maybe major indices, rather than this very distinct market response, which is kind of general easing of risk positions and specifically kind of negative focus on peripheral European equity markets and the banking sector in particular. So why would that be? Well, I think there is a real recognition of kind of Europhobia becoming more like Euro fatigue now. There's always something like this coming along. It tends never to really kind of develop into anything quite as negative as everybody was expecting. And so a lot of investors have found themselves, reacting in a way that they thought was quite rational at the time, but ultimately then being caught through short risk assets when eventually the market becomes much more relaxed about the outcome to various European events. So thinking specifically about Cyprus and about the conditions which exist for Cyprus now, this ultimatum has come out. There's this suggestion that come Monday, Cyprus may leave the Eurozone. It's difficult for investors to really apply much credence to that after the European Central Bank spent so much of the second half of last year fighting against this notion and completely vanquishing this notion of convertibility risk. The suggestion now that it's going to completely reverse its course on that and virtually force a country out of the Eurozone, and all for the want of a reasonably small amount of money, 5.8 billion euros, which clearly is a big amount of money, but in the context of other bailouts which have gone before, in the context of, say, the amount of quantitative easing that the US is doing every month, this is just a completely insignificant amount of money. It seems really difficult to imagine that the ECB would follow through on this ultimatum, even if Cyprus doesn't come up with some form of, if Cyprus is unable to find the funds which it's being required to find. Then we come on to what is its reaction, and it seems like Cyprus has come up with a plan which we happened to sort of just discussed on the desk really a few days ago. I mean, not the specifics of this plan, but it did seem like a good bank structure which people keep using as a potential solution to most of these Eurozone banking crises. But in this context, it really seems a very sensible approach, because you have this obvious cut-off of 100,000 euros where deposits are guaranteed up until that level. So those liabilities could go into the good bank, and consequently the more at-risk deposits go into the bad bank. It seems like Cyprus is interested in instigating that for the Bank Popular, so that's the distinction from the model which we happen to have discussed. But it seems a reasonable way of fulfilling its sort of moral obligations to small investors, and so you would think that it's got a reasonably good chance of passing in the Cypriot Parliament. And the other thing, I suppose, apart from the equity market reaction, the euro has continued to fall, which is positive, really, by way of positive for the economic prospects of the region. And the Spanish debt auction went pretty well as well, so that indicates that investors are not concerned about any great degree of contagion stemming from this event.
It hasn't just been the euro affected this week. Asian stocks fell and the yen gained. We also had the Bank of Japan governor's first press conference that stated once again that the bank could bring forward open-ended asset purchases due to begin next year. What impact did Kuroda's comments have on the markets?
Yes, modestly negative, I think, really, in that there was hope that we were going to have an extraordinary meeting of the Bank of Japan's Monetary Policy Committee, that we were going to see something happening much sooner. I mean, it's challenging in this risk-off environment. The problem that Asia has is that it has to open and kind of judge what the European reaction is going to be to what's going on in Cyprus. So what we tend to see is that the Asian markets see bad news from Europe. They see, say, yesterday's negative PMIs, and they think, this is going to be a bad session for Europe, and so they open lower. And when Europe eventually opens, you find that investors have got this mentality that I described. They're worried about being caught underweight equities, and so there's a much greater sense of sort of investor complacency, and Asia struggles to discount that appropriately. So the yen clearly has retained its role as a funding currency, as a carry currency. So it sells off when risk appetite is high. When risk appetite is low, as it is at the moment, then you see a bit of stability or a bit of strength from the yen, and that's what we've seen. And there was nothing about Kuroda's press conference that was able to offset that.
Now over to the US, we heard from the FOMC statements say it would continue with quantitative easing for the foreseeable future, but it did say it may ease off on the amount of bonds it buys. Now, some investors clung onto this statement as hope that the Fed could ease QE this year. Do you think that this could happen as we've had such positive data recently from the US?
And the way you've characterised that is absolutely spot on, that people cling on to these suggestions, and we have them all the time from Fed members when they do speeches. Any suggestion that there's going to be any let-up in the pace of quantitative easing in the States is really seized by markets. Just, for the next few hours or something like that, it doesn't tend to have a lasting influence, because eventually you'll have some opportunity for the chairman to speak, and his comments always bring the market sentiment much further back down to earth. And so we remain, I think, probably relative to consensus, we think that the FOMC is going to keep buying probably more bonds and for longer, as in keep up the current pace for longer than I think the consensus is currently believing. There's a great deal of emphasis placed on this 6.5% unemployment number, and when we might reach that 6.5% unemployment number, at which point interest rates are likely to go up. I know this is the next step after the easing off of quantitative easing, but the unemployment rate is extremely sensitive to estimates of participation in the labour force, and so whenever Bernanke speaks, he always makes reference to the employment to labour force ratio, which currently is at 58.5%, and pre-crisis was up above 62%. So I think that's a much more logical metric to look at, because there are fewer woolly assumptions that need to be made for it. And to get to 60% by 2016, you really need to be generating 250,000 jobs a month. We're not at that pace at the moment. And of course, over the summer, we're going to start feeling the impact of sequestration as well. So I think there's plenty of reason to think that policy will remain very loose in the States for quite some time. And that's despite the fact that we're very positive on US growth.
Thank you to Mr. Foster there for his expertise. That's all from me this week. We'll be back on Monday with an overview of events to watch for next week. I'll leave you with some great quotes from our latest Dukas Copy interviews. Have a great weekend.